Alright guys, before we get into the strategy, the main guide, you're gonna need these apps. MetaTrader 5, you're gonna need a broker. So to plug it into your MetaTrader 5 and also TradingView for back testing and so forth. But these are basically the three things you need. You need a trading app, which is MetaTrader 5 or 4 or CTrader. You guys can just Google those. Then you're gonna need a broker. There are many other brokers out there, but you can just look at a broker. They're gonna give you your login, and that's where you're gonna deposit your money on. So you're gonna use the broker to deposit your money so you can trade on MetaTrader 5, R4, or CTrader, and you use TradingView just to give you that analyst, that extra back testing. Okay, so that's basically it. Guys, so in this section we'll talk about liquidity, what is liquidity, how to spot liquidity, and so forth. Liquidity is very important when it comes to trading, when it comes to mastering the chart and placing your order. So basically liquidity refers to where a pair, whatever pair you're trading, can be bought or sold within the market. Liquidity zones are areas you find a lot of manipulation. So basically, the financial institutions normally manipulate the market at these areas. So basically, you think that it's going in this direction when it goes for a reversal and so forth. So basically, the liquidity areas help you to identify what the market is doing or what the major financial institutions are doing, help you to spot the manipulation that is happening. Alright, so how do you spot these areas? So you go on any time frame, whether the 5 minute, the daily, the 15, and just mark out the highs and the lows. So the highs and the lows represents the liquidity area. So the high would be the buy side, low would be the sell side liquidity, right? So you just mark these areas out, including the wick of the candle. So the stick, you just mark that out of the high and low of the chart. And what you do is that you wait for the liquidity area to be swept, and then you look for your entry. All right. So a lot of the retail traders would think this area, right? So a lot of the retail traders would think this area would be some form of support or whatever. So the price would head back up. So they'll say, yes, I'm right. But then the market would just go in the opposite direction and they wonder why. But it's just the manipulation that is be happening. Okay. Do is mark out the highs, the lows. We already mark out the highs and the lows. So what we're gonna do now, we're gonna wait for either one to be swept. And this is where I'm telling you. So many persons will think this is support and they'll go ahead and place their buys, and then the market will just go back in the opposite direction. And we also have a fair value gap right here. We'll get into that further down in the guide, but there's a fair value gap right here as well. So price will tend to respect the fair value gap. And basically a fair value gap is just where price, there's an outburst or a great form of movement in the market. It usually represents a 3 candle movement. So we see where price just makes a sudden movement right here as well. And we just mark it out. We just mark it out from the bottom of the first candle to the top of the bottom candle. And we just play it. Alright, so we see where price respects this fair value gap, respects this area where it was there. A lot of outburst movement, right? And then it takes out the sell side liquidity. So many persons would have bought and then it wouldn't have gone in their direction or favor, and they'll be stopped out. So basically their stops, their sell stops, where they place their sell stops, would have gotten hit, taken out, and they end up losing the trade. But on the other hand, we just always wait for the reversal. And there he goes again. He goes back up, and there, and the retail traders would be like, oh, it's going back in the same direction, the same era. But as I said, there's other mechanics, other analysts that you look at, and you see where again price would normally respects the fair value gap, or where there is a sudden movement in the market, right? And it goes again, hits it, and heads back down in the opposite direction. And that's how you normally just take your trade as you go along, watch it plays out, and it tends to dip and go down even further, right? So basically, that's the whole buy side, sell side liquidity, how to spot the liquidity. So the summary is mark out the highs, mark out the lows. You can always look if there's any fair value gap or any other analysis as we go along. I'll get into those further, such as the order blocks or the breaker blocks and so forth. Then you just wait until the liquidity gets swept. Wait until liquidity gets swept, and wait until it respects an area of interest and heads back in the opposite direction. And basically that's it. Alright guys, so in this section we'll talk about fair value gap. So I kind of went over it in the previous session about liquidity and so forth, because all these things, they correlate, they tie into one another. So you always use them for that extra confirmation when you're trading, when you're making a move on the chart. So you see I talk about this in this section and that section because they all interlap, they all correlate with one another. All right. So what is a fair value gap? So a fair value gap is a three candle movement. So basically where you see just an outburst in movement in the market in a particular area, right? So whether it goes up or down, you look for that movement, that sudden outburst movement, and it's a three candle confirmation, right? So we have a fair value gap right here. There's 1, 2, 3. So three candle movement pattern. So we'll mark out from the bottom of the top candle to the top of the bottom candle, right? This is the fair value gap. I will just mark that out. So that is the fair value gap. And we can call it FVG if you're naming it. So we're just going to add a text to it. And that's just the fair value gap. We highlight our fair value gap, we mark it out, and we just wait for price to tap in and respect it. So price can either inverse it. If it goes up above it, then comes back and go up again, or it just comes and then it goes down. All right, it can go either way, but price normally respects these areas, so you can always add it to when you're trading. Right, so we're gonna play it out. All right, so we're playing it out. Price comes in, boom. All right, so price comes in. It's not always gonna be a clean tap in, but you can always look out for these areas. So it's not gonna always be a clean setup, but once everything goes according to what you're planning or execution, then you can just take the trade. So we see where price comes in, goes a little bit above it, but it still came back down, right? So you're always gonna just wait for the candle confirmation. Comes back again, and at this point we see where price respects it. So if you wanted that extra confirmation, that extra, oh, if you didn't want to enter the trade right here, you could just also wait again and see where it taps in and on that to the exact it taps in. So we see the fair value gap, marked it out, drag it out, and you see where prices came in and sold off. So it respects it, right? If you didn't want to enter here, that's fine. You just wait again. So you gotta have patience. And he came back, tapped in again, and he just sold off. Perfect, but that's okay. Part of the trading, part of the game is that you have patience. So we didn't catch it perfect here, but he came back and you retest that fair value gap again, and we saw where it sold off, right? We saw where it sold off. So it might not get you perfect, but if you have a lot of patience and you just wait again to see is gonna happen, you see where it comes back, touch it, and it's sold off, guys. So part of the game, you gotta have patience, but we see where the fair value gap was respected, right? If you didn't want to take the trade here, you can just wait again and take it right here. And we saw where it respected and it came back down. So that's just the fair value gap, a 3 candle movement, right? You marked it out from the top candle, bottom wick, to the last candle, top wick. So it's a 3 candle movement. 1, 2, 3. We mark it out. We saw where price came in, tapped in, and sold off, right? So this is what you're looking for when you're making the trade, taking the trade. You look for these fair value gaps and so forth. But that's it. It's the same thing that happened in the previous previous session, where we saw price tapped into the fair value gap in the liquidity. The same thing happened right here. So guys, just look out for this, incorporate it in your trading, and it will definitely help you a lot. We talk about break of structure and change of character in this session. So basically, a break of structure is where you're in a uptrend, right? Or you're in a downtrend, but you haven't changed character as yet. All right, so basically, this would be a change of character. We were in an uptrend, as you guys can see, we were in an uptrend, but price ended up changing to a downtrend, right? It was going up, then it came down. It was going up, then it came down. That's a change of character right there. And you can know this by, we had a low right here, right? We had a wick and price rally through and close right here. So this would be our change of character, where you can see it changed and went down. So you see it continued into a downtrend. So this could be our change of character. So that would be our change of character. So we were up in an uptrend, then we changed into a downtrend. As you can see, this was in our uptrend, but the candle closed right here. It closed below, therefore it resulted in a change of character. And from a change of character, we have other stuff like order block and breaker block presenting itself. But with the break of structure now, the difference now with the break of structure, you're still in the trend, you're just forming different highs and lows within the trend, right? So at this point right here would have been our break of structure. We're still in the downtrend. As you guys can see, we're still in the downtrend. We're just creating different highs and different lows within the trend. So we're still in the trend. the trend. We haven't gone back in our uptrend. We're still in the downtrend. As you can see, we're just forming different highs and different lows within the trend. So we haven't changed any character. We had to move from a uptrend to a downtrend, or a downtrend to an uptrend. As yet, we're still in the downtrend, creating different highs and lows within the downtrend. So that's the difference right there. So we're still in the downtrend. We're just breaking structure. So breakup structure is literally this. Here's the structure right here, and we break the structure, and the candle closes. So here's the structure, and we literally break the structure right there. So you can see where the price, the candle break this line right here. So basically that's just the break of structure. And we also can let it play out a little bit. And once we let it play out, what else did we notice? We noticed a fair value gap, a 3 candle movement, and play it, see if price taps in and respects it. We see where price taps in, respects it. Alright guys, so we talking about order block in this session. Order block is the last opposite moving candle before the break of structure. So basically the order block is the last opposite candle before the break of structure, right? So want to highlight it. So this is our last candle right here, right? So that's our last candle before the break of structure, and the break of structure would happen right here, because here's the structure, the candle break below and closed, and you see where it changed, right? So that's the break of structure. So, and this is the last opposite moving candle, right? So this will be our order block. So that will be our order block. We can just drag it out, right? We just drag it out. And what do you realize? It taps into the order block. It's sold off. It's sold off, right? So that's basically when price tapped into the order block, it's sold off. We can also see it down here. And we can also see it down here as well. We would have last opposite moving candle. Drag it out. That will be our order block. Break the structure. It'll be right here. Tapped in. Boom. Came back. Went off. Right? That will be the order block. So as you guys can see, that's the order block. Moving again on the chart to see last opposite moving candle before the break of structure. That is the order block. So right here, we would have the order block right here. Drag it out. What do you realize? Price tapped in. So tapped in right here, and it went off, right? Break of structure. You could say the break of structure. If you want to be precise and accurate, you say right here. You could say even right here as well. And even here. But the most accurate one would be here and here to make the order block more valid, right? But we can see where price tapped in and it went off. Just like that. It tapped in and it went off. So that's basically the order block. It's the last opposite candle before the break of structure, right? So just remember that. We're gonna put everything into one now for a trading strategy. So we're gonna mark out our highs, mark out our lows, look for our fair value gap, look for our break of structure, look for our breaker block and order block to execute our entry, right? So this is what we're gonna do. Mark out the high, mark out the low. So we marked out our high, we marked out our low. Wait for the liquidity to be swept, right? Wait for the liquidity to be swept. All right, has been swept, right? So then we're going to wait for our market structure shift is just the change of character and the break of structure. Different names, but the same characteristics, right? Have we gotten a break of structure? So basically, guys, what has happened? We have our buy side liquidity, we have our sell side liquidity. Sell side liquidity has been swept, right? What do we know? Follow change of character, break of structure, the order block, and the order block would be here to here. Drag it out, right? Price came back, tapped in. We're gonna play it out. Tapped in again, boom, and it took off, right? So that would down here would be our entry up here, right? So we wait until price swept liquidity, which is sell side liquidity, right? Then once we see that market structure shift or that change of character, right? Well, we notice this by this high is higher than this high, right? So it changed, there's a shift in the market, and this will also result in the order block being formed where price came back down into the order block and it went off. And your other point where you could just place your TP. So there you go, guys, that would be our entry model, right? So we'll just go over the summary again. So mark out our high, mark out our low. This would be our liquidity points, buy side liquidity, sell side liquidity. Wait until there is and then we'll wait until there is a run on liquidity. Then we wait for that market structure shift or that change of character in which we see where this point was higher than this point, resulting in a market structure shift. You can wait until a candle closes, or you can simply go off the wick. Some persons go off the wick, some persons go off the candle close, but nevertheless, what follows after a market structure shift, change of character, or break of structure is normally an order block. So we see the order block is the last opposite candle, and this would be the red one right here. We mark it out. We see our price came back, tapped into the order block, and it's sold off, just like that. All right, guys, and that will just be our entry model right there.